Good evening, everyone. So, welcome back to our evening classes for this a very, I'll say, overlooked topic in direct taxes, but I believe a very significant one when it comes to the practice of direct tax, the different types of, you can say, taxability aspects. This particular topic brings out a different way of looking at the act, I should say. So let us understand this with all the different special effects of this topic. Yes, very good evening, Megha. Very good evening, Geet. So let me take you ahead in this topic, which is generally considered to be or called as the residuary head. I don't have in calling it as a residuary head. I too have the same view, same opinion. But then there is one small problem, I should say. Many times, when we call it as the residuary head, we assume that anything which is not taxable in the four heads, which is not fitting in the four heads, will automatically be placed under this head. This is where I have a problem. What I mean to say, first point, other sources is not a dustbin. What do I mean by not a dustbin? Means anything cannot be fitting in other sources with only one parameter that it is not fitting in the other four heads. This is an incorrect approach. I'll explain how. For anything to be fitting in any head, even if you remember our previous discussion of capital gains, it has to first fit in the criteria of income. And income means two things. Income which is regularly considered, normally considered as income, that is the revenue items. And two, the special items which are expressly decided to be considered as income. Now, until and unless, sorry, anything is not fitting in any of the regular or special meanings, it cannot be income in the first place. And if it is not income in the first place, it cannot be any head of income in the second place. So first to be clear, other sources cannot be treated as a dustbin to dump anything that you receive. See, what is a challenge, and especially at this final level, I have been always saying that you should be more looking at things from the angle of advisory, consulting, and tax planning, and not only computation. Till now, we were looking at things, okay, what will be the computation, whether it will be taxable, exempt, etc. However, this is not the case now. It is more to be looked at from the angle of consultation. That is, you are an advisor to a person and you have to analyze and advise that, okay, what will be the tax effect? And second, from the perspective of a legal proper tax plan. Now, when I come to other sources, I have seen that many times we are looking upon other sources as if a particular receipt, I'll use this word because this is where all the confusion is. If a particular receipt is not fitting in any other head, it will automatically fit in this particular head. But this is not at all correct. Only if it satisfies, if it crosses the criteria of income under 224 section of the Income Tax Act, then only you can classify it under other sources. So if something is not taxed under salary, so other sources, something is not taxed under PGBP, so other sources, maybe okay in generic sense. But at final level, you have to go a step back and first check if it is income under 224. First thing. Second important point about other sources is that other sources has its own identity also. What I mean by this, when we say it is residuary, we generally believe that, okay, you have to first give importance to the first four heads and what is not falling fitting in those four heads will by default fit in other sources. This is not correct, because as I said, other sources has its identity, whereby I mean that there are some items which are specified to be taxed under other sources. So those are the items which cannot be taxed under other heads, because other sources is the designated specified head for those items. So this is another important point, that residuary does not mean that it is of no importance or it will be to be looked at the last. No. Certain items it will fall here only. Now comes the most interesting part of other sources, that is, in other sources there is a very interesting scenario or a possibility that at the same time, an item can be PGBP and even other sources. It may be HP or other sources. At times, it may be capital gain or other sources, which means that there is some thin line of bifurcation made by the law, that when that item would classify under PGBP and when under other sources, or under salary and when under other sources, and so on. I'll give you few examples. First is interest and dividend. I'm sure when you hear this word interest and dividend, the first thing that will come to your mind that it is other sources, and I also agree to you. But again, as I said, this is the most interesting part, that it can parallelly be classified under some other head, which is even PGBP. How? If I am a bank, a financial institution, for me, interest dividend will be PGBP and not other sources. Though I may have few interest dividends coming in other sources also. How and why? For this, let us go back to our discussion of capital gain, that with what intention I have made the investment. If those are my trade investments, it will fall in PGBP. If those are my non-trade investments, it will go to other sources. Now you'll ask, sir, what are trade and what are non-trade investments? The answer is, try to recall your accounting subject, where particularly in the topic of goodwill valuation, you would have come across this majorly, that as a business, at times there are certain investments which are required to be made if you are in a particular line of business, if you want to do a particular line of business, because those investments are either mandated by some law or those investments are required as a trade practice. Those investments are trade investments. And any other investments which are not mandated by law, not required by trade practice, but you are doing because you have surplus funds, or you want to park your money for the time being till you actually utilize it for your desired business purpose, then that is a non-trade investment. Whatever interest dividend you earn from trade investments will always be PGBP. So I'll give you an example of this. So let us say I am running a business, or let us say I'll give you a flavor of income tax law also in this. So I'm SEZ unit, where I have earned profits, for which section 10AA of the Income Tax Act gives me some tax rebate, tax deduction, whereby for first 5 years 100%, next 5 years 100%, and last 5 years 100%, with the condition of maintaining a reserve. Now, when I'm maintaining this reserve, which is a compulsion as per the income tax law, I am parking the money as per the provisions of the Act strictly till the time I actually utilize it for the purpose of reinvestment in SEZ. Till this period of time, if I am parking the money as per the requirements of the law, then that becomes a trade investment. Any interest dividend I am earning will be my PGBP income. Though in all other cases for the same business, it will be other sources income. Second example, let us say I want to get a dealership of a brand, let us say Britannia. Now the Britannia company has a requirement that whoever wants to be a dealer will have to keep a security deposit of 10 crores, which bears 6% interest. Now this 6% interest which I am getting on this security deposit with Britannia company is again my PGBP income, because that security deposit I am keeping so that I can do business. If I don't keep this deposit, I am not allowed to do business. Again, it becomes a trade investment. But any other deposit which I am doing, that will be non-trade and it will be other sources. So it is interesting to note that in other sources, many times there are situations where the income is parallelly classifiable under some other head, either because Income Tax Act specifically provides this or because of these type of reasons, which I had discussed even in case of capital gain chapter, that many times it depends upon your intention. That is the intention with which that particular activity is undertaken, that particular investment is done. Sorry, that will decide whether it is a trade investment in this particular case, whether it is a capital asset or otherwise. So the same analogies have to be applied here with perspective of other sources. Another interesting aspect of other sources is originally there were six heads of income. Do you all know this? That there were six heads of incomes originally? Yes, students, did you all know that there were six heads of income under other sources? Okay. Geet says no. Megha also says no. Chitra says no. Okay. So let me inform you, the original Income Tax Act had income from salary as the first head, interest on securities as the second head, then house property, then business, then capital, and then other sources. These sections allotted for interest on securities were from section 18 to 21, which are today blank. So 15 to 17 is salary, 22 to 27 is house property. This in between section 18 to 21 was relating to interest on securities, which was later merged with your other sources head. So today, interest on this particular category of securities is part of other sources income. But originally in the law, it was a separate head. Now the point is, originally other sources head was very small, you can say, and was very casual or normal head. Over a period of time, different items started getting added up, started getting loaded in this particular head with a very important, and I should say a very sole intention of avoiding tax evasion. Like the very first thing, if I can recall, is winnings. Today, we all know winnings is part of other sources. But if you logically see, winnings is not income in the first place because it is a windfall game. It is where you have not taken any effort to do something. It has happened because of luck by chance. It is, or I should say, it was not considered as an income in the first place. Later on, when they found that many people are regularly involved into betting, gambling, etc., or into buying lotteries and getting some benefits from lottery, they decided to tax it by first bringing this in the definition of income as a special item of income and then allotting it a head. And obviously, most appropriate head would be other sources because this income does not have the characteristics of salary or rental income or a business or even a capital gain. Slowly and steadily, as time progressed, you find that the list of incomes covered under this head has expanded and it is expanding every year. Every alternate budget, you'll find some or the other things getting added in this head. And mainly or solely, I'll say, the reason is avoiding tax evasion. Like few years back, immediately after COVID, a very interesting category was included, that is virtual digital assets. Have you all heard this, students? Virtual digital assets, VDA, we call it in short. Do you all know what is virtual digital assets? Virtual digital assets. Heard, sir, but don't know in detail. Okay. Okay. Anybody else? Do you know what is virtual digital assets? In short, we call it as VDA. It is okay. I have some more inputs. Okay, yes, Geet, you're right. Okay. So, as Geet pointed out, one of the things, crypto. Now, over a period, many of these transactions which are in the virtual world, like crypto is the most happening and the most common example. But interestingly, when I was researching on this few years back, I think in 2019 or 20, I was amazed to know that people even are spending in millions to simply buy or to simply, yes, I should say buy only, purchase uh, a photo of a monkey who is having a cigarette. And that also a digital photo. Do you know this? Yes, Chitra. Now you have got the word NFTs. Chitra, what is the full form of NFT? You're right, Chitra. Non-fungible tokens. No, it was so amazing for me, and even I was amazed at the point that how can people spend in millions for something which is virtual, and that also image of a monkey. When I went further to analyze what is happening in the virtual world, I was even shocked to know that people are even buying properties virtually, buying and selling properties virtually. People are virtually visiting a restaurant. Means it was whole together. Even when I'm telling you, you'll find it is so filmy type of a thing. But people were actually spending money, real money, for some virtual any of these activities. Yes, metaverse. I'm sure you all would have heard this metaverse. So all these things, crypto, your NFTs, metaverse, all these are unreal things. They are everything on the net. But today that has such a huge impact on our lives that we are ready to spend real money, hard earned money on this. I don't know with what understanding and expectation. Now this was getting untapped, untaxed. So interestingly, in 2022, if I'm not wrong, budget, they even brought this into the taxation domain. And again, under which head? Other sources. So you'll find that every time there is some or the other new thing coming up, and where one, as I said, one is Acha, Sanjay is adding one point. One can also buy a lunch dinner with a film star. Acha, Sanjay, I was not knowing this. But how will you have lunch or dinner with the film star virtually? So what happens, Sanjay? Can you explain us? Yes, Sanjay. Sanjay, any input that you have on this? It can be arranged and then bought and sold. Okay, but means so the dinner which is arranged, lunch which is arranged is real. This is what you are saying. But then what I have done the booking, this booking I can sell to others. Acha. But that is then not a virtual digital asset. Then it is not coming in VDA. Correct, na? Okay. Okay. Actually, I'm not aware of this particular thing, so I cannot comment whether it is VDA or not. But what I'm trying to explain to students is that these are those real life scenarios where you will understand the importance where I started with this, that this is always an ignored head of income. It is always considered as something which is not relevant because it is residuary, but that is not the case. If you see what is now actually covered, you will be finding that okay, these are the things which are happening, and now the tax department is trying to bring maximum thing into taxation, and wherever there is no appropriate head, it is always the other sources which is their sought after head of income. Now, before we go to the incomes, the computations, the disallowances, and the litigative aspects, the first interesting point is what is the method of accounting? What do you mean by method of accounting? Method of accounting means, like we all know, in accounts we have two methods. One is the cash basis, and the other we call it as the mercantile basis. Do you all know by which method incomes are to be computed and taxed? Incomes have to be computed by the cash basis or by the mercantile basis or by any other method. Okay, Geet says any method is allowed. Fine. So again, Sanjay is also saying cash and mercantile. So do you mean to say any method is allowed? Okay, Geet says as employed by the assessee. Fine. I'll again, interestingly, the point is that headwise, the Act provides different methods. Yes, Megha. So for salary head, section 15 says salary will be taxed on what basis? Cash basis, that is receipt basis or accrual basis, whatever happens first. So if you have worked and your salary has become due, it will be taxed, whether received or not. If you have received salary in advance, though you have not worked for that month, but you have taken the salary in advance, that will be taxed. So salary head is taxed on due basis or on receipt basis, whatever happens first. HP and CG, house property and capital gain, these two are taxed on accrual basis, mercantile basis, with one or two exceptions. Like in case of capital gain, insurance claim tax on receipt basis, then your compulsory acquisition compensation tax on receipt basis. So few items are exceptions. Otherwise, general rule is it is taxed in the year of transfer, that is accrual. Same as with HP income, it is taxed whether or not the rent is actually received. So house property CG is accrual with one or two items as exception. PGBP and other sources. There is a specific section in the Act in front of your screen, section 145. And what does 145 says? It says that for both these heads, you are having a choice. It can be computed in accordance with the method which you are regularly following. So for doing accounting, if you follow mercantile basis, we will apply mercantile basis. If you are applying cash basis, you will apply cash basis. This rule applies to both the heads, PGBP also and other sources also. Another interesting point in this is that business wise, you can have different methods. So there is no compulsion that you have to follow accrual for all. So if I have 6 businesses, for different business, I can have different methods and it will be accepted. Similarly, in other sources, I may have multiple sources of income. Again, I have choice to apply different methods for different sources, provided it is the method regularly employed by me for my accounting. Can this method be changed in future? Yes, that is also no problem. But again, one, you should have justifiable reasons why you are changing, and second, it should not be again changed back to the original or the previous one. Means you cannot change it every year. So there has to be consistency. Again, few incomes are an exception to this rule where 145 will not apply. Means over there, option does not apply. In those incomes, you have to compulsorily follow only one method which is provided in the law. Interestingly, similar to accounting standards, you have ICDS, which is the standards for income, what income computation and income disclosure. So, like how we have accounting standards for preparing and presenting our accounts, similarly, in income tax, we have the income computation and disclosure standards, which have to be applied by the assessees other than individual HF, whose books of accounts are not required to be audited. But for others, it is compulsory, but it applies only when you are following the mercantile system of accounting, and it applies for computation of PGBP and other sources. Now, now coming to the head, which is the head of other sources. Now let us see what does the charging section, which is the first section of this head, says. I think the entire income tax is under maintenance. The website is not working. Okay, at least this is working. Now, 56 is the charging section, where 56.1 tells you what types of income will be covered under this head, and 56.2 gives you an exhaustive list that these incomes will come under other source only. So firstly, what does 56.1 says? It says that income of every kind which is not to be excluded from total income, means which is not exempted, correct? Under this act shall be chargeable to income tax head under other sources if it is not chargeable to tax under any of the heads specified in section 14, items A to E. So if any income is not classifiable under any other head of income, then it would be falling under other sources. But what does subsection 2 says? It says in particular and without prejudice to the generality of subsection 1. Because subsection 1 again make other sources look as a residuary head, but that is not the case. Subsection 2 says, however, following incomes will be only taxed under other sources. So it has given you an exhaustive list as to what will be taxed under other sources. And then there are some conditions, requirements, etc. that we will be dealing with, and we'll be understanding each of these incomes in detail. So this is what is the charging section. Now proceeding further. Now, what are these incomes? We will go to each of these incomes in details because each income in itself is having many dimensions, right? So, firstly, I'll just show you the list, what is given in the act, what will be covered under other sources. So, it says dividends. It says then it gives you list of those incomes which are referred to in different clauses of section 224, and then again some other specific items like interest on securities, but then with a rider that it is not covered under PGBP. Then planned income from the hiring of plant machinery furniture if not covered under PGBP. Income from hiring of plant machinery furniture along with building if not covered under PGBP. So it has given you a list of items where, as I said, there is a possibility that it can be classified under different heads, like income which is referred to in clause 11 if not taxable under PGBP, or even salaries. So there are certain items which may have parallel applications under other heads also. So you have to also check that it is not getting taxed in any other head. Then only obviously you will tax it or consider it over here. So this is how section 56.2 gives you an exhaustive list. Now we are going to deal with this in detail one by one with all the various dimensions of that particular income. So starting with the first income, which is dividends. Now we all know dividends are covered under the head other sources. But interesting is to note the definition of dividend, the wideness of the concept of dividend. So who will read for me today? Who will be helping in the reading today? Yes. Okay, Geet, you can go ahead.
Dividend covered by Section 222, Clause A to Clause E. According to Section 222, the following receipts are deemed to be dividend. A. Distribution of accumulated profits entailing the release of company's assets.
We'll first read the headings and then we'll go to details. So A is distribution of accumulated profits entailing release of company's assets. That is A. What is B?
Distribution of debentures, deposit certificates to shareholders and bonus shares to preference shareholders. C. Distribution on liquidation. D. Distribution on reduction of capital. E. Advance or loan by a closely held company to its shareholders. F. Amount received by shareholder on buyback of shares by domestic company.
Okay. So these are the various specific items which are covered in dividend. Now, again, let me tell you interestingly, students, see, there are many times many provisions have some backdrop, some stories. So originally there was no such definition of dividend in the act. This was added later on, or I should not say there was no definition. There was, but it was not so exhaustive. We all understand what is dividend. See, every year the company, after making profits, has to pay back to the shareholders because they have invested, they have taken the risk of become the owner and the shareholders of the company. So they should be rewarded. So the company gives them dividend, which is normally or in the uh, original years, it was simply by way of giving them money. So dividend warrants were given, and through the dividend warrants or checks, people were given the dividends. However, as time progressed, and once the tax implication on a particular person increased, let us say I have a major stake in Reliance and I'm getting huge dividend from Reliance and I am falling in a higher tax bracket. So I suddenly start finding out ways of trying to adjust this tax or avoid this tax. And that was done by a very interesting mechanism whereby the company, instead of giving you money as dividend, generally, what is dividend? You'll get some dividend warrant. Now it is directly created to your bank, the bank which you had specified at the time of purchase of shares. Earlier, some 12, 15 years back, until then, we used to get by post the dividend warrants. It is like a printed check, which we used to go and deposit in our banks. Now, dividend generally should come in money form, but people started finding out new methods of avoiding tax on dividends by taking dividends in different fashion. So came up this elongated definition as to what all would also comprise dividends. So normally what you get is dividend is fine, but it says following receipts are deemed to be dividend. Deem means whether or not the company shows it as dividend, because in fact it is some adjustment done to avoid the tax. That is why it is saying whether or not the company is showing it as dividends, we will deem it to be a dividend. But what is very important, when you are bringing a deeming fiction, it should not happen that genuinely something is done by the company. But since it is fitting in the deeming fiction, it becomes a dividend, then it may be unfair. Hence, there are some internal safeguards to avoid this type of a thing. Now, starting with each of the clauses. So, as I said, originally money used to be given as dividend. Then people started finding out new mechanism to avoid tax. How? So what initially started was that now let us say the company has to pay me dividends which is amounting to rupees 20 lakhs, which 15, 20 years before was a good decent amount. Even today 15 lakhs, 20 lakhs is a big amount. Now how am I taking this dividend? Instead of taking money, I am telling the company that boss, you do one thing, you purchase gold coins or you buy a particular model of motor car and you give that motor car to me. Now, interestingly, keep this with the backdrop that there was no tax on gifts also earlier. That has also been brought from 2004 onwards, and today we have the revised section. So, it was not even fitting in gifts, and most important, it was not also considered as dividend because it was not coming to you in money form. So came this first clause. Then, once the company started giving all these types of things as dividend. Clause A provided the taxability of that. Then the company found out a new mechanism that instead of giving you something, they started giving their own debentures, deposit certificates free. So instead of giving you some asset, now they are creating liabilities in their books by giving their own debentures, their preference shares, etc. free. Then at the time of liquidation, by default, the company has to repay back to the shareholders. At the time of reduction of capital, the company has to pay back the shareholders. In all these scenarios, then the law envisaged as to what will be considered as dividends. So first is where company is giving you some vastu, some item that will be considered as gift if it satisfies condition A with all the safeguards. Please read.
Distribution of accumulated profits entailing the release of company's assets. Any distribution of accumulated profits, whether capitalized or not, by a company to its shareholders is dividend if it entails the release of all or any part of its assets. Note: if accumulated profits are distributed in cash, it is dividend in the hands of shareholders. Where accumulated profits are distributed in kind, for example by delivery of shares entailing the release of company's assets, the market value of such shares on the date of such distribution is deemed dividend in the hands of the shareholder.
Now, what is the safeguard? The safeguard is the starting point that it should be out of accumulated profits. Now, see, we all understand anything to be considered as dividend has to be out of profits of the company, either the realized current profits or even the past profits which are accumulated. Now, what is important is that if you are, you means the company, is having some balance in the general P&L, profit and loss account, which is the accumulated balance or any type of reserves, free reserves, and now the company is giving you its assets or company is giving you some debenture, bonds, etc., then we will consider it as dividend. So, what is the safeguard? Let us say the company is not having any balance of profits or reserves, and the company is actually giving you some assets or something that will not be considered as dividend. So, by default, dividend will come only when the company has profits. So, they have brought in this safeguard internally that if the company has any profits, again, capitalize or not makes no difference. And now the company is giving you anything free of cost by way of distributing its assets, that will be considered as dividend. And the question come, what will be the amount of it? They simply say the market value of such items which are given by the company will be considered as the amount of dividend. Go ahead.
Distribution of debentures, deposit certificates to shareholders, and bonus shares to preference shareholders. Any distribution to its shareholders by a company of debenture, debenture stock, or deposit certificate in any form, whether with or without interest, and any distribution of bonus shares to preference shareholders to the extent to which the company possesses accumulated profits, whether capitalized or not, will be deemed as dividend. The market value of such bonus shares is deemed as dividend in the hands of the preference shareholders. In the case of debentures, debenture stock, etc., their value is to be taken at the market rate, and if there is no market rate, they should be valued according to accepted principles of valuation. Note: bonus shares given to equity shareholders are not treated as dividend.
Now, what is the second item? So now company is not giving away any assets of its, but the company is creating liability in its books by giving away its own debentures, debenture stock, etc. to you free of cost. Now, this is also dividends in your hand, again with the same condition that the company should have sufficient amount in their accumulated profits or reserves. In this, what is very important to note is that even bonus shares given will be considered as dividend, but there is a criteria. Bonus share given to preference shareholders only is considered as dividend. Why? Because giving bonus shares to equity shareholders is one of the normal, you can say, mechanisms which is also provided in the Companies Act. So it is not something that the company is giving to you a dividend under the name of bonus share, but it is practically also bonus shares are given. So where bonus shares are given to equity shareholders, we will not consider it as dividends because it is normally given. But where it is given to preference shareholders or debenture stock is given to anyone, we will consider it as dividends. Anyone means shareholders. Now this is interesting. What happens during distribution, during liquidation? See, whenever a company is under liquidation, after repaying all the outsiders, now comes a turn of the shareholders. Now, when it comes to the turn of the shareholders, at such times, the company has to repay back everything that belongs to the shareholder. Now, what all things belong to the shareholder? One is the capital, and second is all accumulated balances, that is reserves and profit balances. Now, interestingly, this dividend concept, when they crafted this, they even kept this in mind that when at the time of liquidation, where the company is closing down permanently, at that time also there can be dividends. What will be dividends at that time? It is the amount again which is attributable to the profits of the company. So, how this is determined? So, at the time of liquidation, after repaying back all the outsiders, whatever is the balance of capital entire balance is there, and whatever is the balance left in all reserves, that is transferred to shareholders account. Now we find out the ratio. Okay, how much is transferred to the shareholders account? So we say 100 crore of capital and 500 crore of all different types of reserve balances. All. So total 600 crore is transferred to the shareholders account at the end, at the time of liquidation. It means every shareholder, whatever it is receiving from the company, is in the ratio of 1:5. So out of 6, 1/6 represents the amount towards capital and 5/6 represents the amount towards dividend. Now let us say I receive 10,000 rupees in money form and I receive a motor car belonging to the company. What is the fair market value of this motor car? It is 2,50,000 today. So against my shareholdings, I received 2,60,000 worth of something from the company. Now this 260 has to be bifurcated into what is towards capital and what is towards reserves. How? In the ratio of 1:5. So this 2,60,000, 10,000 money plus FMV 2,50,000. So total 260 is to be apportioned in the ratio of 1:5. So it will come somewhere around 11,666 and the balance. So this 11,666 is towards the capital, means it is towards the shares. I will be considering this 11,666 as my amount towards, sorry, I think my ratio is going wrong. So 260, how much will be 1/6 of 260? 6 4s are 24 and 6 3s are 18. Acha. So it is something 43,333. Sorry. So out of 2,60,000, 43,333 is the 1/6, which is towards the capital, and the balance is from reserves. Now, in my hands as a shareholder, I have given you back my shares. I am having two incomes. One is the capital gain on the shares and dividend. Now, for computing capital gain, what will be the full value of consideration? It is this total 2,60,000 which I have received upon 6, because 1:5 is the ratio. So 1/6. And that comes to 43,333. So this becomes a full value of shares. Let us say I had purchased these shares for 30,000. So I'll subtract 30,000. So balance 13,333 is my capital gain, long term, short term, whatever. And the remaining amount out of 260 minus this 43 is the amount which is deemed to be dividend under section 222 clause C under other sources. Have you understood this bifurcation, this working, students? Exactly, Geet. So this is where now I'm connecting to section 46 bracket 2 of the capital gains. So under section 46 2 of the capital gain, this same scenario is discussed, but actually the working is coming out from this dividends definition. Is this point clear to everyone, students? Anybody, any questions, doubts? So we are discussing dividends. Now let us say company ABCL Corp is under liquidation. Now, after repaying all the outsiders in the shareholders account, it has transferred the share capital balance, which is 100 crores, and all the reserves, general reserve, P&L, capital reserve, statutory reserve, all reserves amounting to 500 crore. Now, this is what it is going to repay to all its shareholders. Now, how it is repaying? The company is saying, okay, boss, I have some cash and I have many assets. So let us do one thing. Instead of I selling these assets outside, I'll give these assets to you. So it has cash, it has different motor cars, it has different furniture items, it has multiple buildings, and it has some plant and machinery. So out of all the shareholders, I get from cash rupees 10,000 and one of the motor cars out of the total motor cars whose fair market value is 250. So I get 260 worth of money from the company on its liquidation. Now here, firstly from the company standpoint, section 46 bracket 1 applies, where company under liquidation is giving away its assets. It is distributing its assets. This is not regarded as transfer under 46.1. There is no tax in the hands of the company. Under 46.1, there is no tax liability in the hands of the company. However, at the same time, in the hands of the shareholder, section 46.2 applies. What does 46.2 says? I have received all this by giving away my shares in this company. So I am getting this by giving away the shares. But will this whole amount be considered as my amount received against shares and the entire amount will be considered for computation of capital gain? 46.2 says no. It says that when at the time of liquidation, when you are getting anything from the company, you have to read two sections parallelly, 46.2 read with 222C. In fact, 222C is the one which is first creating the dividend income, and hence 46.2 says only the balance is towards your capital gain. Now, since the company has a ratio of 1:5 between capital and its reserves, so whatever the company is giving has to be bifurcated in this same ratio 1:5. So I'm getting something like this 43,333 and the 2,16,667. Now, in my computation of income, I will be having two computations. One is capital gains on the shares, which I have returned to the company, where full value of consideration is this 43,333 minus cost of acquisition, assuming my transaction is taking place after 23rd of July, and I had purchased the shares for 30,000. So and plus income from other sources, deemed dividend under section 222C, which is this amount, that is 216 This will be my income computation of this year for the purpose of this particular one item which I have received during the year. Is this clear? Anybody having any questions, doubts? Let me know, please. Students, I'm waiting for you. Clear. Good. So this is 222C. Then similar provisions are made at the time of reduction of capital. Now, what is reduction of capital? So the company law provides that if during the continuity of the company, that is the company is not yet under a dissolution, if the company has now company's cash rich, it is having huge profits, the company can reduce its liability towards capital also by repaying back some portion of its capital. Obviously, it has some restrictions, it has some calculations. So, to the extent what is allowed by the companies, that company can repay back its capital to the shareholders. But again, whenever it is repaying back to the shareholders, since the shareholders had invested and till date the company has accumulated some reserves on account of that share capital invested, hence the company will be returning back to the shareholders both some portion of capital and some portion of reserve. The same thing is what is covered in 222D. Please read 222D.
Distribution on reduction of capital. Any distribution to its shareholders by a company on the reduction of its capital to the extent to which the company possessed accumulated profits, whether capitalized or not, shall be deemed to be dividend.
So whatever you are receiving again at the time of distribution or reduction of capital, and this is again out of the company's accumulated profit. So this common thread you will find is passing in everything. Why? Because without this it cannot be considered as dividend. So this is an internal safeguard to ensure that something which is not a dividend should not be taxed as dividend. Fine. Now comes a very interesting and a very critical one. So this was not there originally, despite of the above clauses. This were added a bit later. Now what is this? This is where a private company is giving loan or advance to a shareholder who is a major shareholder. And for the purpose of this section, who is a major shareholder? A major shareholder is one who is having 10% or more of your voting shares. So, if a private company gives loan or advance to a shareholder who has more than 10% of its voting shares, that particular shareholder has to treat that loan deposit advance as dividend. Now, this is something very interesting. In the books of the company, it is shown as loan only because company has given loan, company has given advance. But for the shareholder, it becomes income because it will be treated as dividend under 222E. Now, this particular point has many carve outs, so we'll understand this with more focus. Please read better.
Advance or loan by a closely held company to its shareholder. Any payment by a company in which the public are not substantially interested of any sum by way of advance or loan to any shareholder who is the beneficial owner of 10% or more of the voting power of the company will be deemed to be dividend to the extent of the accumulated profits. If the loan is not covered by the accumulated profits, it is not deemed to be dividend.
So,
Advance or
so one second. So, two words are important. One is closely held company, which means a private company, and shareholder who is the beneficial owner of 10%. Now, Do you all know, students, what is a beneficial owner? Students, you all know what is a or who is called as a beneficial owner? Yes, recorded as such by depository. I'm asking in general, but you are telling me something which is very specific only to demat account holders. Sorry. Who is a beneficial owner? This word you will come across multiple times in taxation law, especially in income tax. Yes. See, when it comes to assets, any asset, one is a registered owner. Who is a registered owner? If a property is in my name, if a car is purchased in my name, the RTO registration is in my name, or here shares, the shares are in my name. I am as the member in the members register of the company. So the company records my name as the shareholder. So all these are examples of registered owners. Now, who is a beneficial owner? Beneficial owner is the one in whose name the property does not exist. So the property, whatever it is, shares or land building or motor car, is not in the name of that person. But the person, as pointed out correctly by Megha, has the right to enjoy the benefits of that property. I'll give you a few examples. Like many times in case of trust, a trust, especially a private trust, is created with this particular thought process in mind that the property which is transferred to the trust, even though it is in the name of the trust, but all benefits arising out of the property should be used exclusively for the beneficiaries. So the point is that in case you are not having that asset in your name, but because of some other agreement contract like creation of a trust or like even in your various bank accounts, you have a nominee. Now the question is nominee a beneficial owner? Answer is no. Nominee is not a beneficial owner. Please understand the difference. Nominee is a person who will become the owner in case the main owner in whose name that particular account is FD is expires. So don't mix between a beneficial owner and a nominee. A beneficial owner is the one who has the right even today to enjoy the benefits of the property. And this is in various special circumstances like trust, or let us say, I'll give you another example. If somebody is a minor, so a caretaker is appointed by the court, and all the things are given under the control of that caretaker till this person becomes major. In that case, there is a possibility that the properties are also with the caretaker who stands in the capacity as a custodian, as a guardian, and the caretaker is only a caretaker. He never is the owner. Owner will be the minor, but maybe after attaining an age. So there are these some special agreements, contracts where today the property is not standing in your name, but you are having rights over that property or rights or to enjoy the benefits out of that property. So similarly, here also this term beneficial owner means what? Beneficial owner here means the person either in his name the share is there, then automatically he's the owner plus beneficial owner because he'll get the benefit, or the share is standing in somebody else's name, but the contract is such that ultimate benefits are coming to this person only. So many times people buy shares in somebody else's name, but with a condition that all benefits will come to me. So that person is considered as beneficial owner. So if I am holding around 10% or more of the voting power, means the equity shares, then this section triggers. So for triggering of this section, two conditions: the company should be private and this shareholder should be a major shareholder. Please proceed.
Advance or loan by a closely held company to a specified concern. Any payment by a company in which the public are not substantially interested to any concern, that is HUF firm, AOP, BOI company in which a shareholder having the beneficial ownership of at least 10% of the equity shares is a member or a partner, and in which he has a substantial interest, that is at least 20% share of the income of the concern, will be deemed to be dividend.
Okay,
Or
now, this is the second part of this section. First part says where the company has given me the loan, it is dividend or deemed dividend. Second part is the private company is giving loan to some other concern. Concern may be a partnership firm, or maybe a proprietary firm, or maybe a company, any other entity where I have at least 20% of stake. So if it is a company, I have 20% shares of that company. If it is a partnership firm, my PSR is exceeding 20%. If it is proprietary, no problem. I have 100% stake. So either the loan is given to me or to any other entity in which I have 20% or more of the stake. In such a case, that loan, that advance is considered to be deemed dividend in my hands. So it may be given to me directly, or it may be given to any such concern in which now who am I? I am that 10% wala shareholder. So I am the 10% holder in your company who is giving the loan, and you are giving loan to another partnership firm or company where I am having substantial interest. So don't mix between these two percentages. In the company who is giving loan, I should have 10% or more of the shares. And the entity to which this company is giving the loan, there I should have substantial interest. Substantial interest is that particular point, which is the key point over here, because substantial interest is different from 10%. Substantial interest is different in entire income tax law to mean the 20% stake. Yes, go ahead.
also any payments by such a closely held company on behalf of or for the individual benefit of any such shareholder will also be deemed to be dividend. However, in both cases, the ceiling limit of dividend is to the extent of accumulated profits.
So what is said? Any payment by such closely held company on behalf of or for the individual benefit of any such shareholder will also be deemed to be dividend. However, in both cases, the ceiling limit of dividend is only to the extent of accumulated profit. So the company is giving to me, or it is giving for my benefit to any of these concerns, is all covered under this particular point. So firstly, understand what is covered. Then we go to the other part, which has been carved out or which has become the exception. Geet is asking in both cases, Sharjah. Yes, yes. So Geet, that is what I clarified. In either case, whether loan is given to me or to my firm, it is chargeable in my hand. See why I'm telling you. See, this second part is again why, because actually they wanted to give me the loan. But if they give me directly, there is an identification. So it is easily considered as dividend in my hands because of the original section. So what people started devising a mechanism, they asked the company to give loan to my partnership firm where I am having a substantial interest. So from there, I can withdraw from the partnership. That is why this part is very important. Payment made by such a closely held company on behalf of or for the individual benefit of such shareholder will also be deemed to be dividend. So either it should be given to me directly, or it is on my behalf given to this firm, or for my benefit it is given to this firm. Then it is dividend, and in either case it is dividend in my hands only. It will never be dividend in the hands of that particular firm or that other entity. Why? Because that firm or other entity is not the shareholder of the company. How can you call that income as dividends? Fine. Please go ahead.
Exceptions. The following payments or loan given would not be deemed as dividend. First, loan granted in the ordinary course of business. If the loan is granted in the ordinary course of its business and lending of money is a substantial part of the company's business, the loan or advance to a shareholder or to the specified concern is not deemed to be dividend.
Now, what is this first exception? See, they have carved out real, genuine cases, so that, as I said, this entire section is having safeguards so that genuine things should not become deemed dividends. Now, what is this? I'll give you an example. So, this private company is a bank. Now, bank is into the business of giving loans, or it is an NBFC which is into the business of giving loans. Now, if it is the business of the company to give loans, and hence it has given me or my substantial interest entity the loan, that will not be considered as any type of deemed dividend. So, first exception is where the private company's business itself is giving loan, and it is giving loan to this 10% or more substantial, not substantial, 10% or more shareholder, it will not be considered as deemed dividend under this section. Next.
Second, dividend paid is set off against the deemed dividend. Where a loan had been treated as dividend and subsequently the company declares and distributes dividend to all its shareholders, including the borrowing shareholder, and the dividend so paid is set off by the company against the previous borrowing, the adjusted amount will not be again treated as a dividend.
Now,
Note.
what is this point? So this point is that, let us say in financial year 23-24, the company has given me deemed dividends, or not deemed dividend, let me use the word, it has given me loan in 23-24. Let us say rupees 2 crore. Now, as per the provisions of this section, this 2 crores, even though given as loan by the company to me, has been treated as dividends in my hands, and I have paid tax in 23-24 itself. Now, in the current year, let us say financial year 24-25, for which the books are closed now, the company actually declares dividend, and I am entitled to 1 crore 50 lakhs dividend, that is 1.5 crore dividend. But what company does, it says that, boss, I have already given you 2 crores as loan, and now because of the dividend declared, you are eligible for 1.5 crore dividend, but I will not give you the dividend. So the company knocks off the loan which is standing in its book as an outstanding loan in my name. So it knocks off that particular loan against the dividend payable to me. So this year, when the company is actually paying the dividends to all shareholders, obviously I also have a share. My share is 1.5 crore, but it is knocked off against my loan. In such a case, this particular point says now that 1.5 crore is not considered as my dividend. So, in fact, in the year in which actually the company is declaring dividends, it will not be my dividends if it is knocked off against my loan in the books of the company. But if this year, where the company is declaring dividends, it is again giving me the dividend money, again that 1.5 crore will be dividend in this year also. So, this is what is the second point. Please go ahead.
Note: subsequent repayment of loan or charge of interest at market rate does not make any difference in the applicability of Section 222E.
That is fine. So, what is given? Subsequent repayment of loan or interest at market rate does not affect the applicability of this section. Means, now this is the worst part, that 23-24 the company had given me loan. Now let us say this year I am actually repaying back the loan, and maybe repaying back the loan along with actual market rate of interest, which may be 12%, 14%, 18%, whatever it is. Still they say they will not change back what happened in 23-24. In 23-24, when the company gave me loan, income tax treated the loan for me as dividends. It is final. It is not going to change. There will be no recomputation. There will be no going back in 23-24 and removing that dividend from income because today I repaid back the loan. No, it means even if this is genuine loan, even though I'm repaying back in future, maybe with interest, still, whenever I had received loan, it will be, or it has been treated as dividend final. This is what is the most draconian part of this particular section. Please go ahead.
Amount received by shareholder on buyback of shares by domestic companies. In case of buyback of shares, whether listed or unlisted, before 1 October 2024 by a domestic company, additional income tax at the rate 20% plus surcharge at the rate 12% and cess at the rate 4% is leviable in the hands of the company under section 115QA. Consequently, the income arising to the shareholders in respect of such buyback of shares by the domestic company is exempt under section 1034A. However, in case of buyback of shares, whether listed or unlisted on or after 1/10/2024 by a domestic company, any sum paid by the domestic company for purchase of its own shares would be deemed as dividends in the hands of shareholders and shall be charged to income tax at applicable tax rates. No deduction for expenses would be would be available against such dividend income while determining the income from other sources.
Okay, now what is this? Now, this is something which has been very recently added. As you can see, the date 1st October 24. So it is again the year of election where you had the second budget, the Finance Act 2, and this has come in the Finance Act 2. Now, prior to this effective date, so they have made this provision effective from 1st of October 24. If prior to this date, there is any buyback of shares. Now, what is buyback? We all know the company has issued its shares in the market. Now it wants to take back the shares from the market, which is called as buyback. Sorry. Now, whenever there is buyback, interestingly, it is or it should be an income in the hands of the shareholder by way of capital gain. However, there was a provision for some period of time, as you can see, in case of buyback of shares, whether listed or unlisted before this date by a domestic company, additional income tax of 20% plus surcharge is leviable in the hands of the company. So interestingly, there was a provision whereby under section 115 QA, the buyback of shares. So actually it is income of the shareholder. I hope you can understand, because if the company is buying back its shares, it is giving the payment to the shareholder. But this was considered as income in the hands of the company, and the company was paying a flat tax of 20% plus surcharge plus cess. And since the tax was paid by the company, in the hands of the shareholder who was actually receiving this money, the capital gain was exempt under 1034A. However, the previous budget, the last year's second Finance Act, removed this provision, and hence now the position is, if the same buyback is happening on or after 1st October 24 by a domestic company, the sum paid by the domestic company for purchasing its own shares would be deemed as dividends in the hands of the shareholder and shall be charged to income tax at the applicable rate. No deduction of expenses would be available against such deemed income while determining the income from other sources. Now, here there is a catch. What is that catch? Let us understand. Now, in this newly inserted clause F, which deals with buyback of shares of domestic company. So let us say I am holding shares in PQRL and the company has purchased back its own shares from the market, which is called as buyback. Again, it has a specific provision under the Companies Act. So my shares, this entire 10,000 shares are purchased back by the company from me, and the company has paid me rupees 250 per share. So I have received around 25 lakhs from the company. Now, in this particular case, what is the tax treatment? Now, generally, we should treat it as capital gains, because this amount I am receiving by returning back the shares which I had of this company. Now, since I've returned back the shares, obviously the income which is triggering should be triggering under capital gains. But what is interesting from this budget, they have decided to tag this under section 222E. Now again, what will happen? My computation of income again will have two heads. Now under income from other sources, this entire amount 25 lakhs would be regarded as my other sources income, considering it as gift. Sorry, not gift, dividends. Now, interestingly, if this is considered as income entirely, and we just said there is no deduction, I had purchased these shares some time back. This was my cost of purchasing these shares. Now, at least you should have allowed me to adjust it over here. But if they would have allowed you to adjust this over there, this would have become like a capital gain. So what interestingly they have done, yes, correctly pointed out by you, Beda Geet, that they have given a special tax treatment where they are saying that this entire cost will be considered as my capital loss. So it is my capital loss under the head capital gains, because it is as good as for this shares I'm receiving nothing. It is as good as. And the entire amount is a dividend in the hands of the shareholder. That is, whatever I have received from the company against the buyback of the shares by the company, everything, entire amount is dividend. So whatever was my cost of acquisition, that will be considered as a capital loss. So see, in this example, number of shares of A bought by Mr. B at the rate of 40. So 4,000 is my cost of acquisition. Number of shares which the company has bought back at 60. So the company has bought back 20 shares. So I have received 1,200. So 1,200 is my income under other sources under deemed dividend. And this entire cost of acquisition will be my capital loss. Now here, since only 20 shares have been bought back, so only 20 shares valued at the purchase cost of rupees 40, that is 800, will be considered as my long-term capital loss on such buyback. Now in future, if I sell the remaining shares, then against that share, whatever I receive minus whatever is my cost of acquisition, that will be my capital gain. And in future, subject to the conditions of carry forward and set off, I will be able to set off this capital loss whenever I get the opportunity. But the point is, today, this entire cost of acquisition is treated as my capital loss. So this is what is very important in terms of this section of buyback. So buyback has always been looked upon by the income tax from a very specific perspective. So this is what is that specific perspective. Yes, go ahead.
Exceptions. The following also do not constitute dividend distribution in respect of non-participating shares issued for full cash consideration. Any distribution made in accordance with C or D in respect of any share issued for full cash consideration and the holder of such share is not entitled to participate in the surplus asset in the event of liquidation.
So now the exceptions to the entire section of deemed dividends is distribution in respect of non-participating shares issued for full cash consideration. So now we have distributions at the time of two scenarios. One is the liquidation of the company or the reduction of capital. So for that, it is saying any distribution which is made under these two cases, C and D is what? C is a liquidation, D is what? Reduction in respect of any shares issued for full cash consideration. Now, what is this full cash consideration? And the holder of such shares is not entitled to participate in the surplus asset in the event of liquidation. Means what? That these shares are non-participating shares. So when it is a non-participating shares, in that case, they are saying we will not consider it as deemed dividend. So where the shares are regular shares, which are participating shares, only that is where it will be considered as deemed dividend. So where the shares are, I'm sure you all know this category, participating shares, cumulative shares, there are different types of shares. So where the shares are non-participating shares, that is what they do not have rights in the surplus that the company will earn on liquidation. that will not be taxed. Go ahead.
Payment on buyback of shares. Any payment made by a company on purchase of its own shares up to 30th September 2024 from a shareholder in accordance with the provision of Section 77A of the Companies Act 1956.
This is what we already saw above, because up till this date, it was considered as income in the hands of the company. So in the hands of shareholders, it was not considered as deemed dividend.
Distribution of shares to the shareholders on demerger by the resulting company. Any distribution of shares on demerger by the resulting company to the shareholder of the demerged company, whether or not there is a reduction of capital in the demerged company.
Now, this is what, see, at the time of demerger, what happens? As a shareholder, I will be receiving some shares of the new company. Now, this may be received in addition to the share of the old company, which I'm already having, because the old company has split into two companies. One is that old company, plus one of its vertical has split and become a new company. So I get a share of that new company also. Now, this distribution of shares will not be considered as deemed dividend. This is clarified. Correct? There is something in the chat box. Okay, correct. Now, if you can see in all the above provisions, except the last one, that is clause F, in all the above provisions, they have a specific requirement that all these distributions or payments will be deemed dividend only if it is happening out of accumulated profits. Now, there has been a lot of litigation disputes as to what will amount to accumulated profits and what not. So let us discuss. Please read.
Meaning of accumulated profits. Accumulated profits in point A, B, D, and E above include all profits of the company up to the date of distribution or payment of dividend. Building and machinery depreciation fund not to be included in accumulated profits. CIT versus Jaldu Ram Rao, 1983.
I hope you all know what is this. So in accounts, we call it as the sinking fund account, which is created for matching with the depreciation. So every year, whatever depreciation we are having, we transfer it to a special fund, also called as a depreciation fund or at times sinking fund, even though it is appearing as a reserve, but that reserve is not any other reserve. It is just the reduction in your asset, but shown as a separate fund. So that will not be considered as free reserve for distribution. Please go ahead.
Accumulated profits include in point C all profits of the company up to the date of liquidation, whether capitalized or not, but where liquidation is consequent to the compulsory acquisition of an undertaking by the government or by any corporation owned or controlled by the government. The accumulated profits do not include any profits of the company prior to the three successive previous years immediately preceding the previous year in which
It is the taking over of that particular company or business by the government. So many times it may happen like what we call as nationalization, where something is private is now taken over by the bank, taken over by the government, or some private bank is taken over by some government bank or government body. In such cases, what will not be covered in accumulated profits, or I'll say what will be covered in accumulated profits is last 3 years profit only before the date of acquisition. The profits earned by the company before this 3 year period, they are saying will not be considered as accumulated profits. So these are all specific exclusions given in the law, so we have to honor them. Yes, go ahead.
in the case of an amalgamated company, the accumulated profits, whether capitalized or not, of the amalgamating company on the date of amalgamation included in the accumulated profits, whether capitalized or not, or loss, as the case may be, of the amalgamated company.
Okay, fine. Now please proceed with this. This is a very important clarification. Go ahead.
Clarification regarding trade advance not to be treated as deemed dividend under Section 222E. Section 222E provides that dividend includes any payment by a company in which public are not substantially interested of any sum by way of advance or loan to a shareholder who is the beneficial owner of the shares holding not less than 10% of the voting power, or to any concern in which such shareholder is a member or a partner and in which he has a substantial interest, or any payment by any such company on behalf or for the individual benefit of any such shareholder, to the extent to which the company in either case possesses accumulated profits. The CBDT observed that some courts in the recent past have held that trade advance in the nature of commercial transactions would not fall within the ambit of the provisions of Section 222E, and such views have attained finality. Some illustrations,
Illustrations.
examples of trade advances, commercial transactions held to be not covered under Section 222E are as follows.
Now, what is this? Now, see, this is again why I told you it is a very important point, because see, the intention of bringing 222E has to be understood. It was to curb the malpractices whereby actually dividends has to be given, but it was disguised as loan so that there is no tax implication. But where genuinely something is to be done as a part of your trade practice, as a part of some set trade precedents, then it should not be considered as any type of dividend. Example, like I gave you example of that Britannia, where it is compulsory. The Britannia says that if you want to place an order, you'll have to first give advance. Now let us say Britannia, which is a company, assuming for the time it is a private company, and I hold more than 10% shares in that company. Now it is a trade practice of Britannia that if I want to place an order, I will first give them advance, and after receiving the advance, they will then send the material maybe in 1 month, 2 months time, whatever is the set procedure. Now, such advances are pure trade advances, whereby there is no intention of anyone to benefit any other, but it is part and parcel of the practice that there has to be some advances, and only then this particular transaction will happen. Similarly, let us say I'm a machine manufacturer and a company wants to buy a machine, and I also hold shares in that machine. But again, the terms are that the company will first give 50% advance to me. After that, I will start making the machine for the company, and maybe after 6 months, I will be actually dispatching, installing the machine in the company premises. Now, here again, though the company has given me advance for this particular machine, still this advance will not be considered as deemed dividend. So here in this circular, they have tried to bring out such examples where they have tried to make out a case that where it is a trade advance, which is in the nature of a commercial transaction. Means what? It is the set routine, it is a set procedure of that trade, or it is a trade practice to give advances. Such advance cannot be considered as deemed dividend. So what are the exceptions to this? The exceptions are where genuinely the advance had to be given for doing business. Otherwise, that transaction cannot happen. Then that advance cannot be considered as deemed dividend. Now coming to a section which generally you would have not heard of in the income tax law, you would have never read, that is section 8. Because this section is exclusively limited only to dividends. What it deals with? It deals with on what basis the dividends will be taxed, or I should say in which year the dividends would be taxed. Now we already saw section 145 method of accounting, but dividends are having an exception because section 8 is already a section created for exclusively determining what will be the year of chargeability of dividends. So chargeability of dividends is exclusively as per section 8. Please proceed.
Basis of charge of dividend, Section 8. Dividend declared or distributed or paid by a company is deemed to be the income of the shareholder in the previous year in which it is so declared or distributed or paid as the case may be.
So
Deemed
firstly, regular dividends will be taxed in the year when the company declares it. Means somewhat you can say it is on accrual basis, but this is for regular dividends. Now we come to the special dividends. Please proceed.
Deemed dividend under Section 222A, B, C, D. Distribution by a company which is deemed as dividend under Section 222, Clause A, B, C, and D would be the income of the previous year in which it is so distributed.
Now, as we saw in all these clauses, the word uses distribution. So distribution of assets, distribution of debentures, etc. So in such cases, you can say that for these four clauses, the first four clauses of deemed dividend, the year of chargeability is on receipt basis, because the dividend would be taxed in the year when you have actually received this amount, or the company has distributed these amounts, like the company has distributed or given away the assets or given away its debentures, etc. Next.
Deemed dividend under Section 222E. Payment of advance or loan to a shareholder or a concern, as the case may be, which is deemed as dividend under Section 222E, will be the income of the previous year in which it is so paid.
This is again simple for your loan dividend also, where the loan is deemed to be dividend. Again, it is the year in which you have actually received the loan, which will be considered as the year of chargeability of this deemed dividend. Next.
Interim dividend. Interim dividend would be deemed to be the income of the previous year in which such dividend is unconditionally made available by the company to the members who are entitled to it.
Again, for interim dividend, you can say it is more or less the year of distribution of dividend, because they have used the word the year in which such dividend is unconditionally made to the made by the company to the shareholder. So it is generally again the year of distribution. Now the next point is tax rate. Now actually this point has no relevance today, but it is interesting to note that few years back, dividends had a special tax rate under section 115. Now this special tax rate applied to dividend where the amount of dividend received by you in a year exceeded rupees 10 lakh. So if you are receiving dividend about 10 lakhs, the extra dividend about 10 lakhs had a special tax rate. But now all those provisions are gone. Hence, the dividend today will be treated as a regular income. If you are an individual, it will be liable to tax as per the applicable slab rate. So there is no special tax treatment to dividend now onwards. Correct? Then comes the second category of income, which is very common income under other sources, which is casual income. What is this casual income? At the start of this class, I was explaining that all these incomes, which are windfall gains, which are not something which you have earned, but which has happened luck by chance, like winnings from lottery, betting, card games, etc., which is to be taxed at the rate of flat 30%. So it is a special income, and it is taxed only under the head other sources. Then comes interest received on compensation or enhanced compensation. Now, what is this? So, in capital gains chapter, there is a special case where your property is compulsorily taken over by government or by any law, or under any law, for the purpose of compulsory acquisition. It may be taken over by anyone, but it is taken over under any law. Now, such a scenario is called as compulsory acquisition, which is also treated as transfer under section 247. Now, section 45(5) says that the capital gain will be taxed in the year in which you receive the first installment. Interestingly, many times in case of such compulsory acquisitions, the acquisition happens, let us say today, but you receive compensation in 4 years, 5 years, and that also may be in installments. Now, as per 45(5), the taxability happens in the first year when you receive the first installment. Thereafter, even if balance amount is received later, still the capital gains entirely will be taxed in the year of receipt of first installment. Now, since this installment is received after 4 or 5 years, again, it is a general practice that along with the late installment of that particular compensation, the government also pays you interest. Now, this interest will only be taxed under the head other sources if your original income was taxed under the head capital gains. But let us say this land, which was compulsorily acquired by the government, was a stock in trade. Now, if it is stock in trade, then the tax on the compulsory acquisition of land has happened under the head PGBP. Then comes the question, where will the interest be taxed? Interestingly, irrespective of where your original income is taxed, maybe capital gain or PGBP, the interest is always taxed under other sources. Now comes the point of section 145. We studied at the start of this chapter that 145 says that income under that PGBP and other sources has to be taxed either as per mercantile basis or cash basis at the option of the assessee. But I had also said that this rule has certain exceptions, That is, for certain incomes, it won't be taxed at your option. It would be taxed only as per one of the methods which is specified. So here 145B1 provides that notwithstanding anything contained in 45(1), the interest received on compensation or enhanced compensation shall be deemed to be the income of the previous year only in the year in which it is received. So here method of accounting shall make no difference. It will be only taxed on receipt basis. Then comes the next point, advance money received and forfeited. Now, this we studied in capital gain also, that from 1st April 2014, if any amount is received by you as advance against any capital asset, because you were negotiating for selling your capital asset. So you took some token, you took some advance, but this deal could not materialize because of the fault of the buyer. So the buyer cancelled the transaction and you forfeited the advance. If this advance is forfeited any date from 1st April 2014 onwards, it will be taxed as income under the head other sources again in the year of receipt of forfeiture. But if this forfeiture has happened before 1st April 14, then this section does not trigger. The treatment was the advance forfeited has to be reduced from the cost of acquisition of the asset. So this is the difference in tax treatment given. This is what we have already studied under the head of capital gain also. Same table was there. We discussed this in detail. Now comes the most important part. We all know, or we always say, that gifts are taxed under the head other sources. But which gifts are taxed? What are the conditions? So, originally, there was a section introduced in 2004. However, that section, which also covered the same thing, gifts only, that section underwent multiple rounds of amendment. And then finally, that section was replaced by a new section which is in front of you, that is 56, subsection 2, clause 10. Now, this is the section which is presently taxing gifts under the head other sources. Now, what does this particular point says? Interestingly, nowhere in the act, nowhere in this section, they've used the word gift for this section. Though we are calling it as gift, just for our convenience, this section does not uses the word. So what does the section uses? It says that where a person is receiving any amount or property either without consideration or it is purchasing the property for lesser value, that is for inadequate consideration, in either case, subject to some conditions, that particular benefit which you are getting will be deemed to be your income under 56 to 10. Now let us understand this in detail. So let us say somebody gives me a motor car. For the time being, I am not getting into the technicalities of whether motor car is property or not, because that is very important criterion. But just to give you an example, or I'll give you an example where there is no contradiction. So somebody gives me jewelry, and this jewelry the person gives me without charging any consideration, that is free of cost. So in layman's language, I will say that I have received this jewelry as a gift. Second possibility, I go to the market to buy jewelry. And when I'm buying this jewelry, the person who is selling me the jewelry is in desperate need of selling the jewelry. Considering this particular desperation, I give the person an offer, or I strike a deal with that person whereby I say that, okay, this jewelry as per today's market rate is of 2 crores, but I will only pay 1.5 crore. And since the person is in desperate need of money and he is in dire necessity of selling this jewelry immediately, the person agrees. Now, in such a scenario, I buy the jewelry at a price which is lower than its proper value, that is the fair market value. So I'm benefited to the extent of 50 lakhs, because what I should have purchased for 2 CR, I have purchased for 1.5 CR. So 0.5 CR is my benefit. Now this 56 to 10 says that in both the cases where either somebody gives me the jewelry free, or two, I have purchased the jewelry but for a lower price, then subject to satisfaction of other conditions given over here, this will be considered as an income. So whatever I have benefited in both these transactions, that will be an income. Now, what are the basic criterions under this section to be regarded as income is: first, either what I am receiving is a sum of money, that is, I receive money, or I receive property. Now, for property, both possibilities, either without consideration or I purchase the property for a lower price, that is for inadequate consideration. So, either somebody gives me money, which is obviously without consideration, that is, they have given me money. So, let us call it as I have received money free or as gift, or I have received property free or as gift, or I have purchased the property for a price which is lower than its normal price, then this benefit which I am getting would be considered as income in my hands under the head other sources. But this rule comes with certain conditions, certain riders. Now, what are they? First, there is a limit of 50,000. So the benefit which I'm getting is 50,000. How to check 50,000, that we will discuss. Two, this property has a definition. So not everything which I'm receiving free or at lower price will be treated as my deemed income. Only the thing which is categorized or which fits in the definition of property, only if I receive the property free or at lower price, only that is my income. Now, what is property? It says it is first land or building or both, that is immobile property, or it is one of the movable properties which has been listed out. Now, what is the movable property? The requirement is it should be a capital asset. Capital asset in my hands, that is the hands of the recipient. So only when it is a capital asset in the hands of the recipient, then only this property received will be considered as a gift. So some requirements that we need to understand is the provisions of this section would apply only to specified property which is in the nature of capital asset in my hands, not in the hands of the giver. So maybe for giver it may be a property or not, it may be a capital asset or not, but in the hands of recipient it should be a capital asset. Now, what is this capital asset? Again, capital asset as per the definition of capital asset that you studied in the capital gain chapter, and it should be one of the specified assets, the list of which we are going to see. Only when I receive a specified capital asset, and that also if that asset is a property, is a capital asset in my hand, then only this section triggers. If I receive anything which is not a property, or if I receive a property but it is not a capital asset in my hands, it is like stock in trade, it will not be taxed under this particular section. Rather, it will not be taxed at all. So, in order to be taxed, what is important is I should have received this property. Again, the property should be one of the specified items, which we are going to study the list, see the list. And second, it should be received by me as a capital asset. So, in my hands, the intention of holding that property is of a capital asset and not of a stock in trade. Now, when I come to this 50,000 point, because you all know that we normally say that gift exceeding 50,000 will only be taxable. Correct. But how to find out this 50,000? So you have to make 5 categories, and 50,000 has to be calculated or checked for each category separately. So I can receive 5 things as gift under this section. One is money, then immobile property or movable property. Now, within movable and immobile property, there are 2 categories. One, I receive it free. Two, I purchase it for a lower price. Similarly, here, I receive it free or I purchase it for a lower price. So there are 5 buckets. Now, this 50,000 has to be checked bucket wise. So, if during the year I am receiving money, then now again you have a exclusion list as to what will not be covered in this section, like gift received on the occasion of marriage, in contemplation of death, from relatives. So excluding all those exclusion scenarios, all the money which I have received, excluding the excluded scenarios, you will add up all the money. So let us say my friends have given on my birthday, some non-related person has given on the occasion of Diwali. So this is very common. So you receive money in on all these occasions and it is not falling in any of the excluded categories. Then whatever money somebody paid 500, somebody gave 2000, somebody gave 10,000, you will aggregate all the money. And if this aggregate of money only, not the other items, if only the aggregate of money exceeds 50,000, this first item is my gift. So let us say during the financial year 24-25, from unrelated persons and leaving all the excluded scenarios, I have received total money of rupees 80,000. Then this 80,000 is my gift under 56 to 10. I will not club it with my other items which are gift. So each of these items has to be checked independently. So I will do aggregate, but aggregate only of all money, not of other assets. Importantly, 50,000 is not to be subtracted. So if the amount, the aggregate of money received exceeds 50,000, entire 50,000 is income. I hope this is clear. Now comes the second bucket. The second bucket is where I have received immovable property free. So somebody has gifted me land, somebody has gifted me an office, somebody has gifted me a shop, somebody has gifted me a house, a flat. Now all these scenarios, again, I'll first remove the excluded one on the occasion of marriage or in contemplation of death or from relatives. I'll exclude those scenarios because they are not taxed here, or rather they are not taxed at all. Keeping aside the excluded scenario, I have three scenarios where in three scenarios I have received property and these three scenarios are not in the excluded category. Now, importantly, the 50,000 which I have to check for immovable property has to be checked for each of these scenarios independently. So for immovable property, you will not aggregate. You will not aggregate. So which value you will check? You will take the stamp value. And if the stamp value of each of these exceed 50,000, then each of these are treated as gift. So let us say out of the three scenarios which falls in this second category, one of the property which is in very remotest area, in a very outskirt area, let us say the stamp value is 49,000. And for other two, the stamp value is one is 1.5 CR and one is 10 CR. Now, while checking the 50,000 criterion for immovable property, I will not add up, I will not aggregate. So first, where the stamp value of this remote area property is only 49,000 rupees, it is not gift. But the other one which is 1.5 crore and the other one which is 10 crore, independently since they are exceeding 50,000, these two properties value will be considered as my income under 56 to 10. Then comes the third scenario. In the third scenario, again, immovable property transactions are to be considered. Again, the excluded ones have to be kept aside. Now, again, I have two scenarios in this where I purchase the immovable property at a lesser price, lesser than its stamp value. And again, over here, that 10% margin is allowed. So up to 10% less if you are purchasing, no problem. But if you are purchasing even below the 10% mark, then only you consider this. So let us say a property whose stamp value is 20 crores, I have purchased for 15 crores. Now this difference is more than the 10% mark. So this 5 crore difference, again independently I will check. So in this first transaction, I got a benefit of 5 crores because a property having stamp value of 20 crores, I purchased for 15 crores. This 5 crore difference, this 5 crore gap is considered as my income under 56 to 10. I have one more second property transaction which satisfy all the requirements. It is not in the excluded list. Here, the margin is less than 50,000. So let us say the stamp value of this particular property is 80,000 and I have purchased it for 75,000. Now the difference is only 5,000 and the difference is below the 50,000 mark. Now, this second property difference will not be taxed. In fact, it is not even satisfying the 10% criteria. So, anyways, it is not taxed because the difference has to be more than 10%. The same logic which we studied in 50C and 43CA. So, importantly, for immovable property, you have to check the 50,000 value independently for each of the properties. Now coming to the next two scenarios, I have got movable properties free or I have purchased movable property for less than the fair market value. Now where I have got the movable property free, again keeping aside the excluded transactions, I have three immovable properties which I have received free during the year. I will aggregate the fair market value of all three and check the 50,000 criteria. So again for movable property, same like money, you have to aggregate all the values of all the transactions which are fitting in the taxable category, which are not in the excluded category. And if the total of the fair market value, the aggregate of the fair market value of all the transactions fitting in this category exceeds 50,000, then all the three transactions are taxed. And last category is where I purchase the movable property for less than the fair market value. Again, I have two transactions in this category, keeping aside all the excluded ones. I will find out the difference. So in one transaction, the fair market value was 80,000. I purchased for 75,000. So difference is only 5,000. Second transaction, the fair market value was 2 crore. I purchased it for 1 crore 80 lakhs. So the difference is 20 lakhs. So 20 lakhs plus 5,000. Together both is 20 lakhs 5,000 exceeds 50,000. So this 20 lakhs 5,000 is taxable. Here again, the 50,000 criterion is to be checked after aggregating the difference. So please understand, you have to make 5 buckets for this 50,000 criterion. Money, immovable free, immovable inadequate consideration, movable free, movable inadequate consideration. For 1 and then 3 and 5, sorry, 1, 4 and 5, you have to take aggregate. For 2 and 3, you have to take the value of independent transaction and compare with 50,000 criteria. I hope this point of computation of this 50,000 or comparison with the 50,000 mark is clear to everyone. Anybody having any doubts or questions in this? Students, anybody having doubts in this?
In the fifth scenario,
Yes,
you said fair market value is 2 crores
correct.
and
I
purchased for
purchased for
1.8
1
crores.
crore 80 lakhs.
Yeah, 20 lakhs is the difference.
Huh,
And you said add 50,000?
no, I have two transactions. One where 80,000 fair market value item I have purchased for 75,000. So there the difference is only 5,000.
Okay, 5,000 is that added.
First
Okay,
transaction and second transaction is this. So I will
okay.
add up both
Yeah, right.
and then I will check 50,000. It means the first transaction will also become taxable. This is what I want to highlight. If I would have
Yeah,
checked independently, then the first transaction would not have been taxable because in first transaction the difference is less than 50,000. But for movable property and for money, you have to aggregate that bucket.
right.
But you will not aggregate the buckets with each other. You will aggregate within the bucket. So only money will be aggregated, only the movable free will be aggregated, only the movable difference will be aggregated. But movable difference and movable free will not be aggregated, or money and movable will not be aggregated. I hope you understood this.
Yes, yes, right. Thank you.
Perfect.
Thanks.
Excellent. Now we'll take a break because there are some more things in this that we have to discuss. So we'll take a 15 minutes break. We join at 8:10 to take ahead this particular point. Fine.
Right.
Let us proceed. So the first thing that we discussed in this section is regarding the 50,000 computation part. Now we come to some other aspects of this particular thing. Geet is saying in third situation where for CG 110% of consideration less than SDV, SDV is taken as FEOC and CG computed together. And then again the difference SDVC. Yes. I'm coming to this point. Good point raised, Geet. I'll come to that point. Let me first go in this sequence. I'll answer your question. Now the next point is relating to the stamp duty valuation. That is a stamp duty valuation of which date will be considered. Again, this point is the same what we discussed in capital gain. So let us say your transaction happens today, but the final agreement happens after 6 months, which is in the next calendar year. And by that time on 1st of Jan, let us say the stamp duty values are revised. So for this particular purpose, which date stamp duty value is to be taken? The answer is today's, that is the date of transaction stamp duty valuations is taken, provided the token, the advance, whatever has been done today to confirm this transaction is through account pay, check or draft, or through one of the approved mediums. If not, then the stamp duty value of the date of agreement means the document will be considered. Next, where there is a dispute on stamp duty valuation, the matter will be referred to valuation officer. If the valuation officer's value is lower, that would be considered. If it is higher, stamp duty value itself will be considered. Again, same point. Now, okay. So this is a summary. Money, the whole amount, if it exceeds 50,000. So most important point that is clarified here is that 50,000 is never to be reduced. It is only a criteria to decide whether that will be considered as income or not. If the amount exceeds 50,000, entire amount is considered as income. 50,000 deduction is not allowed. Now, what are the excluded scenarios where this section will not apply or where there will be no income under the head other sources despite of you receiving something free or at lower price? So following are the scenarios where this section will not trigger. One, where you have received this money or property from a relative or on occasion of marriage. Now, relative will discuss the definition. What is on occasion of marriage? Some important point. So let us say you got married last year on 24th of December 2024. Now, when it says on the occasion of marriage, it is not saying on the date of marriage. So it is not necessary that only the gifts which are received on the 24th of December will only be excluded. If you can prove that even if somebody gave me a gift 1 month before or 2 months after the date of marriage, but it was for the marriage, because many times it happens that your close relatives may not give you on the date of marriage. They may not be able to come on that date, or many times whenever they come and meet you even before or sometimes later, they may give you the gift. So that is why the law is very conscious of this particular scenario. Hence, they have used the term occasion of marriage. So this is again a very important pointer to be kept in mind. It is not necessary that the gift should be received on the date only. Second, very important point, which is many times ignored. It is saying on the occasion of the marriage of the individual. So you are getting married. Now, generally in our Indian families, you will be getting some gift from many people. Also, at times, your parents, your brothers, sisters, maybe your uncle, auntie, they are also given gifts because in our culture, there are different types of gifts to be given to different family members. Now, importantly, this particular clause or this particular point only relaxes the gift received by the individual who is getting married, not the family members of the individual. So, if you are getting married and if your family members are receiving any gift, that will be fully taxable subject to the 50,000 and other requirements. But it is not in the excluded category. This is what I'm trying to make a point. Next, where anything is given to you under somebody's will or where you have inherited it, it will not be taxed. Where you have received something in contemplation of the death of the payer or donor. Now, what is this contemplation of the death? See, if a person knows that this person is going to die, and the person gives you some property, gives you any of his assets, or say that, boss, after my death, these things will be yours, you take care of it, though no document or will is made. Many times it may happen that the person is nearing the deathbed, the person may not be having the sufficient time to prepare a will. So even if the person says that, okay, I'm making you the owner of my property, that is what is in contemplation of the death of the payer or the donor. So it is something like an unwritten will. So where the person has just before it's there, his or her death, has communicated to you that he is giving you all his property, his or her property, that will be covered in this point and it will not be considered as gift. Then whatever you receive from local authority or any fund, foundation, trust, or again any trust under these sections, that will not be considered as income. However, where such sum or money or property has been received by the specified persons under 13.3. So 13.3 are in case of a public charitable trust, the trustees, the author, the relatives of the trustee, they are 13.3. So if they are getting any benefit from the trust, that has been made specifically taxable under 13.3. So point is what? This particular section, whether it would be applicable or not. So it is saying this relaxation is not available and 56 to 10 would be applicable. So for people who are covered in 13.3, there is no relaxation. Again, by any other fund, trust referred to in this section. Then the transactions which are not regarded as transfer. Interestingly, if you receive any amount, any asset under one of these modes which are not regarded as transfer, again, that will not be considered under this section, subject to fulfillment of other criteria. Then from any individual by trust created or established solely for the benefit of relative. So where there is a private trust and the asset is received by an individual from the trust created for its sole benefit, again it will not be triggered. Further, you all know that at the time of COVID-19, the government had declared either some money value or something for the COVID-19 patients, or in case where somebody had a death in the family because of COVID-19. So again, whatever has been received in relation to that COVID-19 government, what you can call it as any money which the government had declared to give, that will not be again taxed under this section. Then by a member of the family of a deceased person where the government has given any money. Here the family member of a deceased person from the employer of the deceased person without any limit, and from either any other person or persons to the extent that the sum does not exceed 10 lakhs. So besides government, if your employer has given some amount, that will also not be taxed. Or if any third person has given, let us some NGO is giving, then up to 10 lakhs, it will not be taxed, provided where the cause of the death of such person is illness related to COVID-19 and the payment is received within 12 months from the date of death and subject to such other conditions notified. And then these are the conditions which the government had notified. And then from such class of persons and subject to such conditions as may be notified. So accordingly, CBDT has inserted Rule 11 UAC to notify the provisions of this section when it will not be applicable. So here is a list of categories where this particular last clause has given the power to the government to prescribe those cases where it will not be applicable. So these are some of the scenarios covered under this. Again, mainly they are the government related transactions. Now, two important definitions. We saw at the start of this section that only where specified property is received, that will only be taxed under this. Now, what is specified property? Firstly, the property should be capital asset for the recipient. For the giver, it may or may not be a capital asset, makes no difference. What is the property? It should be immobile, that is land, building, both. Shares, jewelry, archaeological collection, drawing, painting, sculpture, work of art, and it also includes virtual digital assets. Now, interesting to notice what is not covered in the list: motor car, personal use items like expensive watches, then plant and machinery. Now, all these things are not covered in this list. Yes, if watches are fitting in the definition of jewelry, then other thing, but only because it is a branded watch or a high value watch. But if it is not jewelry, where it is not made out of any gold, silver, or studded with any diamonds, then it is not jewelry. We have seen the definition of jewelry. So, in such cases also, wherever you have received any of these things which is not falling in the list, it will not be taxed under this section. So, I give you example watches, which are not jewelry, motor cars, plant machinery. This will not be taxed even if they are received free, even if you are getting it as a gift. Next, relatives. Who are covered in relatives? Because if you are receiving anything from the relatives, it is in the excluded category. Now, here again, you have to be very particular when you are reading this list. Your spouse, your real brother sisters of your spouse, then your uncle aunt from both dad side, mom side. So your mama ji, your masi from your mother side, and your chacha ji, tau ji, bua ji from your father side. Then your lineal ascendant, that is your parents, your grandparents from either side. So your dadaji, dadiji, nanaji, naniji, all these are covered. Lineal ascendant descendant of your spouse. So ascendant is all your father-in-law, mother-in-law, your grandparents-in-law. They are covered. And spouse of all the above mentioned persons. So if your son is covered, your daughter-in-law is also covered. If your mamaji is covered, your mamiji is also covered. Now, what is very important to note is your mamaji, mamiji, your masi, masa all are covered, but your wife's mamaji is not your relative under this section. Your cousins, your wife's cousins, or your husband's cousins are not your related person under these sections. So, only the specific names which are mentioned over here will only be considered as a related person. Maybe other persons you may consider them as a relative, it is okay, but they are not considered. Like we generally consider our first cousins, like your real uncle's son, daughter, who are your first cousins. Maybe it may be a joint family, you may be staying together. Interestingly, your uncle aunt, real uncle aunt, are your related as per this definition, but their children, that is your first cousins, are not. So that is important to note that only the specific persons who are named here will be considered as relative, and any gift received from them will not be taxed. Similarly, in case of HF, any member thereof will be considered as related person. So, a summary is made. Immobile property. Now, interestingly, this summary will be answering Geet your question. Now, I'll first tell you what was Geet's question. Now, Geet's question is, so let us say Geet is receiving a building from his cousin. Now, we just discussed that Geet's cousin is not his relative as per this section. Now, this particular building which Geet is receiving, he is not getting it free. He is buying it from his cousin. And the value of that property is 20 CR, the stamp value, and Geet is buying it for 15 CR. So the difference is more than 10%. So that 10% relaxation is not available. Now, this 5 crore difference is Geet's income. But there is an interesting point which Geet is trying to make out. Ki, sir, will it not be a double taxation? How? So look at from the point of view of Geet's cousin who is selling this building to Geet. So Geet's cousin, when you look at from Geet's cousin's point of view, this side has to be seen. And when you're looking at Geet's point of view, this side has to be seen. Now from Geet's cousin's side, where the cousin is selling that building to Geet, which is having stamp value of 20 crores, but it is sold at 15 crores. When the Geet's cousin is preparing his or her tax returns, if that asset is held as a capital asset, for Geet's cousin, it is a capital gain. And if it is stock in trade for Geet's cousin, it is a PGP income. But in either case, section 50C or 43CA applies, because of which, even though the value is fixed between both of them as 15 crores, but Geet's cousin will have to show 20 crores as his full value or sale value. And from that, after reducing the cost, the difference will be Geet's cousin's income. It means this difference of 5 crore is getting taxed to Geet's cousin as a transfer. Same 5 crore is getting taxed to Geet also as a transferee under this section of 56 to 10. Now, Geet's question, or Geet's rather, I'll say pain is, why is this 5 crore getting taxed twice? Is it not unfair if it is getting taxed twice? So this is his pain, this is his question. Anybody would like to answer? Yes, anybody would like to answer Geet's question? Ki, is taxing the thing twice correct? Because 5 crore is getting taxed to the transferor also, that is Geet's cousin, and to Geet also. For transfer, it is taxed at CG or PGBP. There also entire 20 crores is to be considered. So 5 crore is getting taxed to that cousin also. And Geet is also paying tax on 5 crore. So indirectly, Geet is saying that 5 crore difference is getting taxed twice. Is it not unfair? Tell me.
Yeah, it seems to be unfair, but they are two different individuals. So,
But it is the same difference, na? Because there are, see, firstly, do you all know why this particular provision was brought into the law? Because the government has data which shows that in majority of the transactions, more than 95% of the property transactions, there was tax evasion. How? Let us say my property is worth 20 crores. I'm not saying stamp value is 20, I'm not talking about stamp value. Let us say the real market value is 20 crores, but I am entering into agreement of 15 crores. So that 5 crores tax can be avoided, right? This is a common SOP or the common malpractice going on, especially in relating to property transactions. One, because it is high value, and two, because properties are always known for having all the different black money component. Now, in this particular case, the government, when it brought this particular provision in mind, which one? From the seller side, it had this simple criterion that even though the seller is showing on paper that the seller is receiving 15 crores, we all know that since the market value is 20 crores, there is a very good possibility that no seller will sell below the market value. Hence, they brought this in the hands of the seller in the form of 50C and 43CA. And that is where they now see again what is market value will always be a challenge, which will be again a big dispute. So they brought in the concept of stamp value and they give that 10% relaxation. Fine. What is interesting to note is when the same provision is brought into other sources in the form of 56 to 10, Geet's point is correct that, sir, if you want to tax, you tax it once. But if you're taxing it twice, is it not unfair? Answer is no. Why? Because today, let us say genuinely Geet is paying 20 crores. Means that 5 crore extra is paid. That 5 crore is the cousin's income who is receiving this 20 crores but showing only 15 crores on the document. So 5 crores which is paid by Geet, let us say in cash, which is not shown on the document, which we call as the black component, is today definitely the income of the seller, seller, that is Geet's cousin. So definitely it should be taxed in the hands of the seller. We agree to that one limb. But when it is getting taxed to Geet also, we feel that it is unfair. But understand this. Today it is seller's income, so seller is taxed, we are okay. But this 5 crore which Geet is paying to the seller as black, it means it has also been Geet's some past income for which Geet has not paid tax in that year. So if I'm taxing that in the hands of Geet, what I'm indirectly doing as a lawmaker, I'm taxing Geet's that past undisclosed income, past black money, which Geet should have already paid tax in that year. So had this been a proper transaction and Geet would have paid tax in that earlier period, so government would have got tax of this 5 crore in that earlier period from Geet as Geet's income. And today, if they are showing it correctly at 20 crores, again 5 crores the government would have got from Geet's cousin because the Geet cousin is receiving 20 crores. So if today I'm taxing both 5 crores to Geet and Geet's cousin, it is not unfair. Geet's cousin is taxed because he or she is earning it today, so no problem. And Geet is being taxed because from where has he got this 5 crore to give as black? It means Geet has also created that black somewhere in the past. So that past black money of Geet is getting taxed today in the form of 56 to 10. Geet, I hope you have understood or your query is now resolved. And maybe the pain is also gone why both are being taxed. Correct?
But what if there is no black money involved? Then,
Sir, when will it be when the black money is not involved? If you are reporting the transaction below the stamp value, then there is a black money involved. Huh? When will the black money not be involved? Give me example. If you are reporting it below stamp value, so there is a very good possibility that black money is involved. That is why you're reporting below. Huh?
right.
Yes, but there is a possibility. What? That stamp value is inflated. See, stamp value is fixed by government, keeping in mind the normal market conditions. But let us say now, especially in property market, it happens that many times in some areas the property prices are skyrocketing. But after a period, the bubble burst, and suddenly there is a vacuum in the market, and actually the properties are not getting sold at the prices which were there maybe few months back or a year back, maybe because of recession or because of that bubble. But what has happened? Government kept on increasing the stamp value considering the inflationary market conditions. But I've never seen till date any time in any state that the stamp value which was increased is reduced. What maximum government does, like they did during COVID also, for 2 years or 3 years, they did not increase it. Otherwise, they review it annually, and generally it is increasing upward only. So for 2 3 years during COVID, they did not increase it, but nobody took it back. Also, when they are deciding this time value, they are taking the general market data. Now, it may happen that genuinely in my case, because let us say my flat is not Vastu compliant, my flat has lot of internal leakages, and also genuinely my flat is not getting me that much value. That in that case, genuinely, I support what you said that there may be no black money involved because genuinely the value is less. That is where you have the option of referring the value to valuation officer. The stamp value, which is common, which is generic for that whole area, may not apply to each and every building, but it is not done building wise, it is done area wise. So if you feel that your property or your case is genuinely having a lower price than the stamp value, okay, you can go to the valuation officer, you can take that option. Correct?
Yes.
Perfect.
Perfect.
Now, now we look at this transaction more holistically with more aspects. What are these more aspects? So tax and TDS implication both on transfer of immovable property. Now it is for inadequate consideration same. That is same example, 20 crores is the stamp value and Geet transferred it for 15 crores. Now, firstly in the hands of Geet's cousin, that is the seller. If land and building is held as stock in trade, what will happen? Section 43CA is applied. If it is held as capital asset, 50C will apply. In both cases, the same rule applies. Stamp duty value. If the difference is more than 10%, the stamp duty value is taken. Now, here again the question is the date of agreement different from the date of registration? If yes, the date is different, then which date you will take? You will take the date of agreement and not the date of document registration, provided the payment of token, etc., is made through one of these mediums. And stamp duty value on the date of registration may be taken as the full value of consideration if it exceeds 110%. Stamp duty value on the date of agreement will be taken if it exceeds 110%. So that we now have understood, that where the dates are not same, then first preference is date of agreement only, provided the payment is made through this, then the date of agreement stamp duty value is taken. No, then the date of registration stamp duty value is taken. Fine, this is done. Now in the hands of Geet, who is the buyer, is the date of agreement different? Then the same point applies. If the date of agreement is different, yes, then if you have made payment through one of these mediums, then the stamp duty value on the date of agreement may be taken. Otherwise, the stamp duty value on the date of registration would be taken. Second, if the consideration of transfer of land and building or the stamp duty value is less than 50 lakhs, answer is yes, no TDS applies. But if the value exceeds 50 lakhs, we all know there is a 1% TDS under section 194(1)(a). So there is this TDS implication also you have to check, considering 50 lakhs as the TDS cutoff threshold. Now, where this stamp duty value and the actual consideration, there is a difference, and the difference is more than 10%, and the difference is more than 50,000, then in the hands of Geet, that difference will be considered as income under 56(2)(10). So this table summarizes all aspects, the taxability aspect in both the hands and also TDS aspect. So you can just keep this table in front of you whenever you are looking at this particular transaction. Fine. It is explained with the help of this example. I request you all to please go through this today so that you'll understand this entire thing in detail. Now we proceed further to all the other components. Now see, all these are past 5 years amendments. In past 5 years, every year on year, every budget has added one or two new items to this list. Now what is this? Compensation or any other payment received in connection with termination of employment. Now interesting. When I read something like compensation and it is linked with termination of employment, what comes to my mind is VRS. Because it is the compensation for termination of employment, or at times it may be under that Industrial Dispute Act, which is the retrenchment compensation. But both of these are taxed under the head salaries. How come we are reading it over here? Because here it is taxed when it is received from a person other than employer. So where you are receiving the compensation from employer, it is taxed under the head salaries only. Hence, it is said that, however, if it is received from employer, it is taxed under salaries. Now, the question is, why will anybody else other than my employer pay me this compensation? So, that is where again real life scenario comes. So, let us say I am one of the key employees of, let us say I am a very good scientist working in, give me name of any good laboratory. Just bad at recalling names. Any good laboratory or company into pharma?
Ranbaxy.
Ranbaxy. Chalo. So I'm one of the lead scientists of Ranbaxy, and every few months I come out with new formulations, and that gives Ranbaxy a very good sale, because whatever I develop, the Ranbaxy get it patented, and then it manufactures the medicines using those formulations, and it is doing good business. Now you are one of the competitors. Now give me another name of a pharma company which is competitor of Ranbaxy. Which is that?
Glenmark.
Sorry?
Glenmark.
Glenmark. I was trying to recall that name. Nowadays, you have lot many ads. Even Amitabh Bachchan. I forgot the name. Okay, chalo, Glenmark. Now you are Glenmark. Now your business strategies are obviously to promote your business, but many times nowadays businesses are having negative strategies also. If you cannot better your sales or your business, you try to affect your competitors in a negative sense. So you identify that I am one of those lead scientists because of whom Renbax is always coming out with some new formulations and the drugs are hit in the market. You approach me through some direct indirect link and you offer me 100 crores For doing what? For doing only one thing, leaving Renback. So you're giving me an amount for or in connection with termination of my employment. Now, interestingly, this particular payment has, or this particular type of agreements have started since past few years. But interesting to note, there was a lot of confusion whether it will be taxed or not. Let me tell you, if this clause and the amendment in 224 is not there, it cannot be taxed. Why? Because I will repeat the point which I started with in capital gains also and today also. Anything to be taxed has to be income. Income means two things. One is revenue and the other is special income. Special are only ones which are specifically covered in 224. Otherwise, whose names are not specifically covered in 224 will be income in 224 only if they are revenue. Now, if you make me a payment asking me to sacrifice my source of income, which is over here employment, it is a capital receipt. And until and unless that capital receipt is specifically mentioned in 224, it cannot be taxed because only revenue items are income in the general sense. And those items which are not revenue, there will be income because they are specifically covered in 224. Now, till the date this point was not there in 224, technically it could not be taxed under income tax. It was not covered under salary because it is not paid by my employer. Hence, to cover this scenario, this point has been introduced. So, what it covers? Where a compensation is paid by any other person other than my employer, but it is having the same reason to ask me to terminate the present job. That is in connection with termination of my employment. It will be taxed if it is paid by employer under salary. If not, then under other sources. I hope this is clear. Next, any specified sum received by a unit holder from a business trust during the previous year. So what it says, it provides that any specified sum received by a unit holder from business trust during the previous year with respect to unit held by him at any time during the previous year would be chargeable to tax in the hands of the unit holder under the head other sources. Now, what is this amount? Firstly, it is not the amount on transfer of the units. It is like a return on the units. So see, when you are investing in some company shares, the company give you dividend. In the similar fashion, when you invest in units, the unit you are investing is similar to a share of a company. It is a unit of a mutual fund, or here it is a unit of a business trust. Why you have invested? Because you are expecting some returns. So, what will be taxed to you under the head capital gain is what you will get on sale of the units or transfer of the units. But if you are not selling or transferring the unit and your mutual fund, or here in this case, the business trust is paying you something, that is what? That is a return on your investments, similar to dividend on shares. That is what is taxed over here under the head other sources. I hope this is clear. Geet, can you please read this computation part?
Specified sum is to be computed in the following manner. Specified sum equal to A minus B minus C, which shall be 0 if sum of B and C is greater than A. A is aggregate of sum distributed by the business trust with respect to such unit during the previous year or during any earlier previous year or years to such unit holder who holds such unit on the date of distribution of sum or to any other unit holder who held such unit at any time prior to the date of such distribution, which is
So
not.
just read this distribution as dividend. So what has happened? Throughout the year, the business trust of whose units you have purchased, they have distributed or they have given you dividends. Simple. So what you are getting is dividends from the business trust. Go ahead, which is not.
Which is not in the nature of interest and dividend referred to in section 1023 FC or rental income referred to in section 1023 FCA and not chargeable to tax in the hands of business trust under section 115 UA.
Simple. So you have received dividends from business trust and it is not exempt any under any one of the sections of 1023 FC or FCA, because if it is exempt, because it is falling under those sections. Anyways, you don't have to pay tax. So what is this A minus B minus C we are trying to understand? So what is A? A is dividend, which is taxable. So that is why they are saying firstly aggregate all the amount that you have received throughout the year, because you may be receiving returns not only once a year. It is not like a company that they'll finalize their. It depends upon the nature of the sum that you have invested or the mutual fund option which you have taken. Some may be giving you periodic returns, monthly returns. So whatever returns you are getting, that is A, but that will be excluding these returns because they have been specifically exempted. Plus, they will be excluding these returns which are already taxed in the hands of business trust. So what is the income of the business trust tax in their hands cannot be again taxed to you. So logically, what is A? It is the total dividends received from this business trust, excluding the exempted amounts. That is what is A. So A is your dividend received. Proceed. What is B and C?
B is amount at which such unit was issued by the business trust, and C is amount charged to tax under this clause in any earlier previous year.
So what is B? B is your price at which this unit was originally issued, because over and above that only can be your income. And C is any amount which, because of the tax incidence, has already been taxed earlier. So generally this C will not be required because there cannot be overlap. It cannot happen that the same amount is taxed in some earlier also and in this year also. But still, if you read this whole in holistic, what it simply means is whatever return on investment you are getting against this unit and which is not exempt under any of the specified section, that is what is exempt. Sorry, that is what is taxable. Next comes the next point, sum received, including the amount allocated by way of bonus under the LIP, other than under ULIP and Keyman insurance policy, which is not exempt under 1010D. Now, what is this? Simply, your life insurance has matured, LIP's life insurance policy. So, whatever amount you are receiving under the life insurance policy, other than the amounts which are exempt, which will be taxed. So, similar to the above point. So, whatever you are receiving other than the amount which is exempt will be taxable under the head other sources. Now, the main exemption section is 1010D. Now, what does 1010D exempts? One, it exempts the normal life insurance. So, if you have taken a normal life insurance, it will be exempt. So, what is not a normal life insurance? Keyman insurance or the insurance which is already covered under section 80DD. Those insurances are not normal insurance. So, that amount is not exempt under 1010D. Second, where the insurance policy is such that the premium for that insurance policy exceeds the 10% or the 20% criterion which is given in 80C. Now, if you recall 80C by chance, 80C is the deduction, chapter 6A deduction, where if you have taken a life insurance and you are making payment of the premium of that life insurance policy, then there is a date which is 1st April 2012. If the policy is taken before 1st April 2012, then up to 20% premium is allowed as deduction under 80C. And if the policy is taken after 1st April 2012, then up to 10% premium is allowed under 80C. Now, this policy, which is eligible, let me use the word eligible for 80C, that is where the premium is below 20% or below 10%, is the same policy which is exempt under 1010D. In other words, if you have taken such a policy where the premium exceeds that 20% or 10% criterion, those policies are not exempt under 1010D. Correct? So here they have given that point to reiterate what is there in 1010D. So 1010D is basically covering all your regular life insurance policies. They are exempt under 1010D, provided the premium does not exceed these limits. These are the limits of 80C, but they have been repeated over here for your reference. Second, it should not be a policy for which already you are having a specific benefit under 80DDB. So if you're already having under 80DDB or 80DD, again, that cannot be exempted over here. And last is a sum received under ULIP, where we all know that where the amount exceeds 2,50,000, the premium of such ULIP, then that ULIP is called as a specified ULIP. And now they have made it specifically taxable. So in respect of ULIP issued on or after this date, any sum received under ULIP, including sum allocated by way of bonus, is exempt. Why it is exempt? Because now it is taxed under the head other sources. Now, excluding these all policies or excluding all these types of ULIPs, all other amounts which you are receiving is taxed under this section. So basically, if I have to give you specifically what is taxed under this section, so you have taken a normal life insurance policy and the premium has exceeded that 10% or 20% criterion. That is what is the life insurance policy that will be taxed here. What is given? Exemption is not available in respect of amount received for an insurance policy taken for a disabled person under 80DD. Exemption is not available in respect of sum received under Keyman insurance. So all these are not exempt under 1010D. Now, when all these are not exempt under 1010D, they are the ones which are taxed here. So one is the regular life insurance policy where this 20%, 10% has exceeded, or second is these special life insurance policies which are not given exemption under 1010D. The amount received under these life insurance policies are what are taxed here. I hope this is clear to everyone. Yes, students, is this clear?
Yes.
Yes, sir.
Okay. So again, they have given small examples here. Please go through them so that all these individual policies and the pointers will be clear. So in short, you have to know what is exempt under 1010D. Other than 1010D, the remaining items will be taxed here under this clause of this other sources head. Is this fine? Okay. Do you want me to go through details of all these policies in detail? I'll do one thing. I will cover firstly the other things of this topic. And if the time permits, in the next class, if we complete everything, we may go through in each of these items in detail. Because our module has very elaboratively given you the entire list of all these items with independent illustrations and examples. Now, after this, the next important point is, as we saw above, a common criterion is that incomes will be taxed under this head, provided they are not covered under any other head. Now, only one income is covered under salary, or there is a possibility that it may get covered under salary, that is that compensation. But for other incomes, the conflict is between other sources and PGBP. Now, what are these incomes where it may be taxed under PGBP, and if not taxed there, then it will be taxed under other sources? That item or that list is given over here. Now, I'll come to clause 1 later. Let me first take the straightforward ones. So if there is letting out of plant machinery furniture independently or letting out of plant machinery furniture which are inseparable with building. Now, in both cases, the rental income that you are getting, if renting is your business, it will go to PGBP. But if it is one of the case where you are having these things kept idle and you have given it on rent and renting is not your business or these are not part of your business, then these these rental incomes comes under other sources. Similarly, interest on securities other than the ones which are exempt under 1015, that interest is also taxable under the head other sources, provided, again, as I said, the interest should be received on those securities which are not trade investments. If the securities are trade investments, the income will go to PGBP. Otherwise, it is falling over here. Now coming to clause 1. What is clause 1? Here I want inputs from you all as to what is covered in clause 1. It says any sum received by employer assessee from his employee as contribution to provident fund, superannuation fund, or any other funds. Can anybody tell me exactly what is covered here?
So this is first included in the income of the SSC employer.
Correct.
Then it is given, the deduction is thereafter given.
And there is a condition when the deduction is given. You are right. Huh?
Yes, if it is paid within the time period required to pay this, or not before the due date. Yes.
Which due date? Due date of the respective act, Provident Fund Act.
Yes,
This is a due date of the respective law.
Correct. Now, again, this point was not there originally in the law. So let us first understand this. See, Provident Fund, we all understand. So let us say I am employer, you all are employees. If Provident Fund Act applies to my organization, then what am I required to do? I am required to every month deduct some amount as per the Provident Fund Act conditions from your salary. Let us say I am deducting rupees 2000 from your salary towards Provident Fund. 2000 I am adding from my pocket. Whatever I have deducted from your pocket is called as employee's contribution. Whatever I have added from my pocket is called as employer's contribution. This 4000 I have to deposit in the Provident Fund account monthly by a monthly due date, which is generally 15th of the next month. Now, originally this point was not there in section 224. Later on, the government or the legislature, they thought that let us bring a special condition so that the employers do not use the money of the employee. See, when I'm deducting that 2000 from your salary, now that 2000 is with me, but it is your salary, it is your money. Now I have deducted it with the purpose of depositing it in Provident Fund account. But as an employer, and now I should say as a businessman, I may have a different plan that I need working capital for my business. Now, if I take a working capital loan, there were times when the loans were given to us at 18%. At times, some cooperative banks even gave at 24%. Instead, I can use this money and I can pay it later after 2, 3, 6 months, 1 year, 2 years. I'll deposit in Provident Fund. That will not be a big cost because the interest charged by Provident Fund to me for depositing late is much lesser than the bank interest. So many times people started this type of tax planning. To curb this, Section 36, subsection 1, clause 5A was inserted. What does this clause says? Only limited to employees' contribution, that is your contribution, that is what I have deducted from your salary, this 2000. Firstly, they said when I deducted from your salary, it is my income under 224. And now they put that condition under 36(1)(5)(a) that we will allow you deduction of this employees portion under clause 5A if I deposit it strictly by the time limit as per the Provident Fund Act. Now let me just inform you for your information and knowledge that this clause is under challenge under various high courts as to whether it is valid, constitutionally valid, legally valid or not. Maybe in 2-3 years you'll get the final verdict. For the time being, we are going as per the bare law. So as per the bare law, the position is today when this contribution is deducted by me from your salary, it is first my income under 224. And then if I deposit it within the time limit of the Provident Fund Act, then only I get deduction. Otherwise, I will never get that deduction. Never. So even if I deposit it 1 day late, I will never get that deduction. I hope you all know this point of 36(1)(5)(a). Now, firstly, they have treated it as my income and then they have allowed me deduction. Now comes the head. If I am running a business and you are my employee in the business, then this amount which I have deducted as contribution is my firstly PGBP income under section 28 And then when I deposit it, it is my deduction under 36(1)(5)(a) of PGBP head. But let us say I am running an entity, but I'm not into business. So it is not necessary that only businessman has employees. There are many entities which are not in business. I have sources from other heads, like I have house property income as my source. I have interest as my source. So I'm running an entity which is having these other heads as the source. It is not having PGBP head because I'm not into business. So let us say my activity is of investment. But obviously I have employees because I require people to run this entity. Now in such cases, when I deduct the provident fund contribution, it is income under 224, but it is not falling in PGBP head because my activity is not a business. This is where this section of 56(2) gets triggered, and they say that, okay, since it is not falling in PGBP head because I am not running a business, then this will be treated as my income under the head other sources, firstly under 56(2), and then section 57 puts the same condition which is given in 36(1)(5)(a), that if I deposit this amount within the due date of the respective act, here the Provident Fund Act, I will get deduction under other sources. So this income is again covered under two heads. If my activity is business, PGBP head. If my activity is not business, other sources head. Is this clear to all students? Yes? All clear? Any questions?
Yes, clear.
Any doubts? No? Great. So we conclude our class here. I request you all, please read the whole topic. Read those scenarios which we were discussing relating to insurance. Next class, we will complete this topic, and if time permits, we will go to the different scenarios. Fine. So thank you very much. Keep studying, keep learning, and grow yourself in the subject. Thank you. Good night, everyone.
Yeah, thank you.
Thank you, sir. Good night, sir.
Good night. Swaminathan.